to do with Tesla, but we'll go over that towards the very end. So first of all, what is an order? An order is a buy or sell action that may be executed at a conditional price or the current price. So I have a little snippet here of the Thinkorswim platform, or rather the top left part of the platform. So each time you want to buy a security or a stock, you could press the buy custom, and from there you could select any type of order. So some of the types of orders include the market order, the limit order, the stop order, which includes the stop loss or stop buy, and the stop limit order. We're going to get into this right now. So first, the market order is an order to buy or sell at the current price. So some of the pros about this is that um, the order is almost filled right away, but some of the cons is that the order might be filled at different price points for smaller cap stocks, meaning that the the stock is not as high valued as others, and there might not be as much trading volume going on. So for every transaction, there needs to be a buyer and a seller, and in this case, there actually might not be a seller for you to buy. Because of that, as shares become more available, as sellers go onto the market and you're trying to buy, you might have to buy at different price points along the way. So yeah, because price is always changing, so your order might not be filled at the price that you thought it would be or that you desire. So the next type of order is a limit order. There are many different types of limit orders. We'll just go into the most basic generalized version of it. So the limit order is an order to buy or sell once the price reaches a specified level. So some of the pros about using a limit order is that you will buy shares at that specified price or the specific price without worrying about a sudden price movement causing the price to jump, or fall all of a sudden. You're buying at a weird ass price. For the con though, it might cause a missed opportunity. So let's say that you predicted an uptrend, and you wanted to set your limit order at 150. What is that? But instead of 150, the share price ends up going down to 155. So your order ends up not being executed. So just because of that $5 difference or deviation between you getting into that position and the actual share price, and the share price ending up at $200, you missed out on a $45 sell opportunity. So when you're setting your limit orders, which we'll get into, you will have to be really conscious of how realistic is it that the price will actually go down to that limit value, or the strike price, what is called, or how likely is it that the limit's even not going to get close to that. So you always want to make sure that you are having opportunities, or you're taking opportunities that you can on uptrends that you're predicting correctly. Just don't be too stingy over a few dollars on the price. A lot of people miss out on like some of the best opportunities in this. Um, Another order is the stop order. So stop orders are usually executed once you actually have shares of the stock, as indicated by the name, the stop. It basically indicates to buy or sell once the price reaches a certain level, but it actually might not be selling at a specific price. So basically, it becomes a market order once the price threshold is passed. So there's no guarantee that once the price drops below the stop order strike price, then it actually might sell at prices lower than that. So yeah, so the pros will be that you may get a better price from an up or downtrend that passes the specified price. But one con is that you don't have control once the stop price is triggered. So that brings us to another type of stop order, which is the stop limit order. So like I said, a limit order is basically saying to sell or buy actually at a specific price, and it will only buy at that price, other than a jumping around super volatile price. So once the price drops below the stop threshold, it will actually buy only at that limit price that you specify. So one pro of this is that you have full control of what specified price to sell at. But one con is that basically there's actually no real like solid con, besides the fact that the order might not be fulfilled, just like the limit order. So when you're thinking of a limit order, just think specific price, full control. You're going to be selling or buying at that specific price. For a non-limit order, that you'll be buying at any price once that sort of execution is triggered. All right, so the next one is a little bit complicated. It's called a trailing stop and trailing stop limit order, or there are two different types of orders. But basically, the stop loss in this case trails the increase in price. So let's say that you have $50 worth of Tesla, or like Tesla stock, 50 $50 per share of Tesla. It was at $50 per share, and it suddenly rises up to $100. Well, you don't want to set your stop loss back down to $40 because then you're going to be losing all the potential profits you made from 50 to 100. So instead of that, you will increase the stop loss to 90, so that instead of dropping all the way down to 40 and then selling, it will just drop at, well, it will start to sell at 90. Going on, if the price were to go up to 150, then you would sell at 140. You would set the stop loss at 140. So basically, your stop loss is following the increase in price, right? So you don't want to just cut all the losses right when like the stop price drops. You don't just want to keep letting it drop down to the point where you lost the initial profits that you made. So this usually happens for stocks that have a very strong uptrend. Basically, that the stock price keeps going up and you don't see it going down in the near future. But in the case that it does, you have the stop loss set at a rational price. It's just going to be following the increase or the uptrend. Um, so when you're manually adjusting the trailing stop loss, you're basically hand ordering the stop losses at different price points. So in this case, there is an undefined or infinite target to stop loss ratio. So this means basically that you can have zero risk and infinite reward because you're going to be having profits that keep going up, and you're not ever going to sell because the trailing stop loss basically follows, and you're just going to continue making profits above the initial buy prices that you had. All right, so now we're going to talk a little bit about a good trading system. So when you're thinking about a trader usually has their own specific system. And in the earliest lecture that we had, we kind of went over how traders have different systems for different market climates. Well, that is true, except when you're having a system, it should be very specific to what actual indicators you're using, which type of price movement monitors or technical analysis indicators you're using, like the moving average, like we went over last week. So basically, it's all dependent on who you are as a trader, but also, as I said, on the market climate. All right, so when we're setting the target price to risk, you always want to make sure that you are executing the best quality trades. So this idea of executing the best quality trade is not really dependent on whether you're making money or not. It's really about how much were you risking versus how much was the potential for reward. So if you look at the picture on the top right, that depicts a one-to-one target to risk ratio. We call that a 1R multiple. In that case, you set your limit order at the same proportion increase as the decrease for the stop loss. So basically, there's the same amount of gap between the current price and the profit taking exit and the stop loss exit. So you're risking the same amount as you look to gain. In the bottom, however, you could see a 3-to-1 target to risk ratio. In this case, the limit order is placed at a value 3 times higher than the stop loss relative to the current price. So yeah, when we're thinking about the R multiple, we're simply thinking about the target price profit over the quantity risked. So you never want to lose more money than you can afford to lose, and that's what your stop loss is for. So you should always consider the amount of your money relative to your account, as I was saying, or the equity that you're risking in comparison to your profit target. So we should always think in terms of, or we should think in terms of our multiples whenever we're placing a trade, because we don't want to be risking more for such a little profit. So yes, this kind of has to do with not really risk management, but just being the most efficient. Yeah, so shoot for high honor multiples. Always shoot high, but not too high, because when you're trying to have a specific outlook on the share price, you're gonna find that a lot of the times it's not gonna actually go up. It might go down. Except you should always have your R multiple high so that the risk that you're making, or the amount of money that you're gonna lose in that trade, is gonna be very little compared to the reward you're gonna make on the next trade that you make. So if you look at the picture on the bottom, there were actually more what is that? There were more red sells than green buy, or sorry, red sells than green sells. Basically, you lost on more occasions than you gained, except during those times that you gained a lot more than when you lost, than in the times that you lost. So as you can see, there's a very big gap between the buy and the sell for the green part, but a very small section for the buy and sell of the red part. So basically, your gains will overcompensate for your losses. So most beginning traders think that once the stock goes too low, and you might actually think like that too, when the stock price goes way too low, you think to yourself that the stock price or the stock will rise back up in the long run. So you're thinking, oh, maybe in like 6 months the price will go back up. So it might actually rise up, as you might have thought, but think about the opportunity cost. So if you take in an economics class, you would have gone over the concept of opportunity cost, meaning the potential gains or like the missed out opportunities you had with that money just because you wanted to keep it in there and see if you could recover the losses. So in this case, just cut the loss, meaning really just lose the money, accept that you lost the money in that trade, but go into the next one. And then from that, you will find that over time, you're going to become more positive than if you were to just become stubborn and hold on to your position. So yeah, it might rise up after a very long time. Just think about the potential gains you could have made if you just kept the money out of that position and allocated it to somewhere else. So yeah, you must always set a stop loss order so that you don't lose more money than you want to risk. So the amount of money that you want to risk, that should be determined before you place a trade. Otherwise, you're setting yourself up for an infinite amount of risk in terms of the amount that you're putting in versus the amount you get out. You'll go out. You might get out zero, or the stock might turn into a penny stock, or you could just cut the loss right when the stock price drops below your stop loss threshold, and you're set from there. All right. Okay, so when you're creating your system or your personalized system for trading, you have what you have to think to yourself is where you want to place limit and stop orders. So as I was saying with the R multiples, your limit orders should be placed at least more than one um, full interval between the current price and the stop loss. You want to be having the potential to make more than what you're risking. So you should actually start a trailing stop loss when you recognize a strong upwards trend. Otherwise, you're basically missing out on opportunities of like huge profits. You're just limiting yourself to smaller profits from placing a limit order just above the current price. So you should also think about how much do you want to risk out of your total account into one trade. So for myself, I think about the 10% risk, which we're gonna get into in the next slide. And also, you should think to yourself whether you want to short sell stocks. So I think we only went over short selling briefly, but when you're short selling a stock, you're basically borrowing or selling the stock at a higher price, thinking that the price is going to drop so that you can buy it at a lower price. So when you're selling it for a high. When you're buying it at a low. So the profit comes from buying it at the lower price, the price difference between the high and the low in which you're buying. So yeah, that's considered short selling. Except in this case, there's infinite risk because think about it. If you were to borrow or sell stocks at, let's say, a low price, and the share price suddenly increased, you would have to buy back those stocks at that very high stock price. So think about if you, what is that, shorted Google like 10 years ago. Think about how bad that would have been because share price would have gone up a lot since then. Um, what you do want to think though is that when you're short selling for the short term. You're probably not going to short sell for a very long time. Shorters usually short for or it's usually a tactic for traders. However, if you look at 2008, there were instances where people shorted the housing market through ETFs, and those people made a lot of money. That's actually in a movie called The Big Short. If you guys haven't watched it, but you guys should definitely check that out. And finally, you should think about which technical analysis indicators to use. So one sort of decision you have to make is what moving average interval should I use? So we went over the moving average last week, but basically it tracks the price or the average price over a specific interval of time. So should use a 40-day interval, an 80-day, a 100-day, or 200-day. So this all depends on your trading style, like what type of quality trades or how quality of trades do you want to buy in at. So the higher time interval that you're tracking, the better quality trades you're going to have, but at a lower frequency. All right, so using a manually adjusted trailing stop. So I depicted one of the trailing stop orders in a previous slide of, I don't know if you guys remember the guy pointing at the little TV screen. It might be a little bit misleading. Along with the trailing stop, you should also have limit orders placed above, because you want to sell at an appropriate price that you think is appropriate. So as you can see, there's the same amount of gap between the current price at each price point. I don't know if you guys can see my mouse at each price point, between here, the buy and the stop loss and the limit. Also here, the limit and the stop loss and the limit, or to this one rather, and the stop loss to the limit. And eventually you sell way higher. So think about if you didn't adjust your orders. If you just kept your stop loss here and your limit here, you would have sold at around here and you would have made approximately half of the profits you would have made with the limit or the trailing stop and limit orders. So you should remember to yourself that if you're predicting a very strong uptrend, or if you're seeing a very strong uptrend, you should always use a trailing stop order or stop loss. So as I mentioned, with the 10% risk rule, you should a general rule is to only risk 10% of your total account for each trade. So let's say if you had a 10% account, that would mean that you're only willing to risk $1,000 per each trade. So the moment that you decide to yourself, okay, I want to risk only 10%, that's when you should think to yourself, or calculate, where should I set my stop loss? So if you were to buy a share of, let's just call this ABC, or no, that's an actual stock. Let's just call it A, right? So let's say you were to buy stock A at $95, 100 shares. You would set your stop loss at $85, because in the scenario that it reaches that stop loss price, you would sell at $85, so basically lose $10 per share at 100 shares. So that would mean you'd lose $1,000. So if you place your stop loss right there, the moment the price hits $85, the order is activated, meaning the order becomes a live market order. So yeah, in this bad case, you would lose $1,000, except you never lost more than 1,000 because you had the 10% risk rule. You don't want to put yourself to liability of losing the full amount of money that you put into that position. When people think to themselves, or people who don't know that much about stocks, they think about, oh, I lost all my money in stocks. Well, yeah, that's because you didn't set a stop loss. You're losing literally all the money you put into each trade. You're losing all of that, right? You didn't set a stop loss to sell at a specific point. So it's better to sell early than later when the stock price goes way lower than your stop loss or your hypothetical stop loss. So yeah, just if you could learn anything from this lecture, if you could only learn one thing, it would be to place a stop loss on your trades. I can't stress how important a stop loss is, because if you're not setting up a stop loss, you're putting yourself liable for infinite risk, or not really infinite risk, but the full value of your account can drop if you put your money into a trade thinking that it's going to go up and not putting a stop loss. All right, that's a very beginner mistake that a lot of people realize often too late rather than early. So yeah, just keep that in mind. Set a stop loss. All right, so just a reflection of your trading style and your system. It should not be someone else's. It should not be someone else you heard telling you how much money they made in their stock trading portfolio. It should really just be an aggregate reflection of who you are as a person, and also your level of frequency of using it, or of using your account. So yeah, it should be based on how much money you have, your personality, like if you're bold, or if you can be kind of scared, your personal outlook, and if you're optimistic or pessimistic. That actually plays a very big role when we're kind of thinking about bullish and bearish investors. We call them bulls or bears. And just a reminder, emotion is a main driver of prices, right? I went over that in I think our first two lectures, that emotion is one of the biggest indicators or the biggest movers of price. So yeah, just keep in check your emotions when you're trading. A lot of people don't realize that right when they get a loss, they're kind of just looking to recover that loss, and then they make reckless trades. So this is kind of why a lot of people discourage paper trading or using fake trade simulations, because you're not really using your own money, so you're not having that same emotional response as if you were using real money. So I would recommend, as I did, using real money, except very little amounts, so that you're obviously not putting yourself liable for that much risk in losing all your money, but also to just use real money to have that sort of emotional response when you're trading. A lot of people don't learn this emotional response early on, so that when they make their first real trade with real money, they turn out confused and they suddenly make a bunch of irrational orders. We want to make as rational orders, obviously, as possible. So we can make that possible by using real money early on and learning your mistakes early when you're not actually have when you don't have tens of thousands or hundreds of thousands in your accounts, just so that you can kind of learn the way that your mind works, the way that you want your system to be constructed. All right. So well, let's talk a little bit about Tesla. This is what I mentioned earlier in the lecture. So Tesla today jumped up to almost $1,800. I don't know if you guys remember, but last week the price was at about, let's say, like $1,000. I think it was at $1,000, and with Tesla getting closer to being put on the S&P 500 or the Standard and Poor's 500 index, there's a great chance that Tesla might become a blue chip stock. So if you talk to someone who's really familiar with investing over trading, they'll really talk about blue chip or blue chip stocks. These are stocks that they like to hold on for the long run. They usually benefit off of the dividends, meaning that if the stock performs really well, or if the company performs really well, the company might decide to actually pay their investors a little bit amount of money for the share they have. That's called a dividend, right? It's kind of like a reward for being faithful to the company. But yeah, it actually might become a blue chip stock. Right now, Tesla's simply listed on the Nasdaq, and once the once the stock becomes listed on the S&P 500, there's a very high chance that it might become, or it might have a higher outlook for being very reliable. Typically, a lot of the stocks on the S&P 500, one, they're very big, and two, they're very reliable for long-term investors. A lot of people think to themselves, or a lot of beginner traders, they often promise themselves that they're only going to buy stocks from the S&P 500. So from that, they're going to think to themselves, oh, there's a lot more price stability with Tesla, or oh, there's a higher outlook for long-term growth. So yeah, with Tesla getting closer to being put on the S&P 500, we're probably going to see um, a lot of volatility actually, with Tesla being put on that index. We're not going to really see that much change for the S&P 500, of course, because Tesla's only going to be one out of around 500. So yeah, so as you can see here, I noted that the bears amassed $20 billion in short positions. So what does that mean? For Tesla, there are shorters who basically put a negative $20 billion worth balance on the stock. So they're basically betting that Tesla is going to drop a lot, right? So they're going to make money if Tesla drops. So what we've seen in the past week or so is that the stock itself has risen up like 40%, like, or like 80%. That's crazy. Um, so there's really no fundamental explanation for why Tesla is moving as such. There really isn't. I mean, I guess the overall lesson here, which I put down, is that the Fed is very powerful. If you guys or if your parents talked about the news, they kind of mentioned that the Fed printed a lot of money. That's all part of monetary/fiscal policy. If you've taken an economics class, basically from this, they are putting more money into the economy to promote growth, and or actually in the case of the pandemic, to prevent like a strong recession. Just printing money is like historically a short-term solution that never worked out. If we look at Nazi Germany in the 1940s, or actually just regular Germany after World War One, there was a lot of hyperinflation after the Germans overprinted money, and that kind of just led to the money being worthless. And if you saw in historical photos, they actually burned cash for firewood because it was cheaper to burn cash than to buy firewood with that cash. So yeah, just the lesson: the Fed is very powerful. I mean, obviously, the Fed is kind of controlled. It's controlled by the government, but it's not really. It's kind of independent because even though it's called the Federal Reserve. So in these cases, the position entering traders don't think. they just buy. When they see the price going up, there's really no fundamental explanation. Like, I don't think there was really any difference in their production. I mean, last year Tesla had $350,000 in production volume. This year or this quarter, they had around the same as last quarter. In fact, there's really nothing good with Tesla right now, right? Besides the fact that towards the middle of the pandemic, they decided to open their factories, and I mean that's illegal. I don't know why they're getting benefited for doing illegal things. Um, so yeah, in these cases, the traders don't think; they just buy. Once the price decides a certain direction, the price will be very strong in that one direction. I don't know if you guys remember Alex, who was here last time, but yeah, he was really passionate about talking about Tesla and supporting it. But overall, I think this whole idea of Tesla rising for like a fundamental reason, like oh they have really strong what is that long-term growth outlooks, it's just silly. Like it's there's no reason for it to rise $800 in a week. I don't know if you guys noticed, but Tesla is the most valuable automaker in the world. Like I think Toyota makes around 10 million vehicles per year, and Tesla only makes what 350,000. I mean, I don't really see it rational that Tesla is worth twice as much as Toyota is. Um, yeah, I mean, you can make the argument that Tesla makes higher quality cars, but really, I mean, Toyota, the volume is so much greater, like 30 times greater, that it shouldn't even be significant. So if you guys want to talk more about Tesla, we could definitely do that. But other than that, thank you. So next week we're gonna go over scalping, day, and swing trades, and the whole idea of making money while you're trading and investing. Um, so just a little bit of a preview. Scalping, day, and swing trades are like basically different types of trading styles. If you hear day traders basically trade within the day. They don't typically hold onto their stocks overnight. They buy and sell within that trading period. Scalper traders, they basically buy or sell within seconds or minutes. They're very high frequency traders. And swing traders, which is kind of along the styles of mine, is where you hold on to the stocks overnight, but you're looking to sell typically under a month, right? So you're trying to sell either within the week, 2 weeks, 3 weeks, but you don't want to hold on to longer than that. You're not really using it as an investment. You're just trying to make a trade. All right, so all of those go under the terminology of a trader or the categorization of a trader. But yeah, we're also going to be talking about the whole idea of making money when you're trading. So there's actually a lot that goes into making money. There's capital gains tax, which we'll get into. There's also ways that you can actually escape that tax by putting your profits or that value from the account, pulling out and then putting it into another asset. We're going to get into that later, but yeah, really, capital gains tax is a very important thing to consider as you become a trader, because it can sometimes rise up to like 30%. You don't really want to lose 30% of all the what is that? All of your profits, or in fact, all the value that you extract from your account. So yeah, we're going to talk about that. That's probably one of the most important parts of the 6-week lecture series. Yeah, thank you. That's all for today.